Last year's spike in inflation to multi-decade highs spurred the Fed to begin hiking interest rates to bring inflation under control. The Fed began an aggressive monetary tightening campaign, increasing its benchmark target rate from 0% to nearly 5% in a matter of months. Throughout this rapid rate hike cycle, we've looked closely for any signs of instability or signs of something breaking. In mid-March, something broke. We finally saw some of the collateral damage from the Fed's rate hikes. On March 8th, Silicon Valley Bank announced that it had sold a $21 billion portfolio of securities in an effort to bolster its capital position. They realized a $1.8 billion loss in the process. This was intended to be a prudent move to shore up capital, since the bank had seen its core venture capital and startup business slow in the preceding months. Instead, the announcement led to immediate panic, and within 48 hours, depositors pulled funds and the bank collapsed. This sent shockwaves throughout the entire banking industry and created a focus on the unrealized losses sitting on other banks' balance sheets. In the ultra-low yield decade following the Great Financial Crisis, longer duration bonds were some of the only investments that offered any yield. So banks invested their client deposits in these bonds, investing in treasuries, loaning to companies, and offering mortgages to home buyers. As interest rates rose rapidly last year, the banks started to incur larger and larger losses on these bond portfolios. According to the FDIC, U.S. banks were sitting on $620 billion in unrealized losses at the end of 2022. The banking crisis that began with the collapse of Silicon Valley Bank caused a rush to safe haven two-year treasuries, driving yields down, and this led many to speculate that the Fed might need to pause or reverse its rate hike campaign in order to maintain stability. As expectations of a Fed pivot to rate cuts began building, the high-growth technology companies of the NASDAQ outperformed. These companies severely underperformed last year as rising interest rates weighed on sky-high valuations. The increase in the equity market this year has pulled the forward price-to-earnings ratio higher, above the long-term average of 16 times forward earnings. Although headline inflation has come down from the highs reached last year, core inflation, which strips out the more volatile food and energy categories, remains elevated and is nowhere near the Fed's target of 2%. Shelter prices are the biggest component of inflation, and these inputs are still elevated. However, we suspect that there's a lagging data point here because rental prices have already begun coming down. It may take time for this to filter into the data. Nevertheless, price increases for restaurants, hotels, transportation, and food remain sticky. The economy has regained all job losses experienced during the pandemic. In fact, the labor market remains very strong, seemingly unaffected thus far by the Fed's rate hike campaign. Job openings, although off the high of last year, are elevated relative to pre-pandemic levels, as there's still a shortage of workers to fill those roles. This is likely driving inflation in many of the service industries. Despite a rally in equity markets and a seemingly strong job market, the bond market is flashing a warning sign about an impending recession. The deep yield curve inversion persists, with the two-year yield more than 0.5% higher than the 10-year yield. A yield curve inversion has historically been an early recession indicator. The Fed now must choose between maintaining stability or continuing the battle to bring inflation down to its target. At its latest meeting, the Fed signaled that it is committed to bringing down inflation and holding rates high through the end of 2023. The bond market doesn't buy it. It's pricing in more than 0.5% of rate cuts through the end of the year. Whether the Fed is going to continue to keep rates high, or whether the bond market is right and the Fed will need to cut due to the onset of a recession, this environment does not seem sustainable for a rally in high-growth equities. Instead, we are investing in low-valuation, defensive sectors.